A holiday shortened week, but there's much going on in Washington. We also don't have too much on the earnings calendar, but we are going to talk about a name that's going to be reporting tomorrow after the close today on open interest. Hello, everybody, and welcome. Welcome to Open Mic. I'm Mike Coe. So we are going to take your questions. Before we do that, I think there's two things we ought to discuss. It does appear that the folks on the Hill are getting close to passing this big, beautiful bill. They've been making some minor changes. There were a couple components that had been included in that weren't necessarily about taxes and things like that Democrats managed to get pulled. There is a little bit of a debate going on right now about how they're going to account for an extension of the tax cuts that were put into place in 2017. Republicans want to essentially outline that extension as if it doesn't have a cost. In other words, that's the existing law of the land in terms of taxes, so they're suggesting that you're just preserving the existing tax code and suggesting, therefore, that the bill is not going to have a tax impact, or at least not on that part of it. Of course, opponents of that are saying these things would sunset on their own if they were not extended, and therefore they should be viewed as something new, and they should be accounted for. And of course, tax cuts, while there may be economic growth assumptions that go along with it, certainly have a cost on the revenue side. And depending on whose calculations you're using, that number could be as much as $3.8 trillion if those things were made permanent. So fairly significant on the debt and deficits front. Now, just sort of continuing on that same thread, last week, and we touched on this, the president had indicated his eagerness to replace Fed Chairman Jay Powell with somebody who has ideas for an easier and more dovish monetary policy than the current Fed Chairman has. And I will say that I don't think that that's a positive if we do get somebody who, for whatever reason, the market views as a lackey of the president, because I think there's little doubt that there's a serious conflict of interest between the various branches of government and the central bank. And that is that the central bank's mandate, in my view, should be a stable currency first and foremost, and maybe exclusively, although they do have a dual mandate right now, which is for the stability of the currency and also to maintain full employment. If that role ends up adopting a new responsibility, which might be lowering the cost of interest expense to the government, whether it's at the behest of Congress or the administration, whoever may be in those respective roles, that is a serious conflict of interest. And the fact of the matter is that I don't think we are in a place yet where we should be encouraging very easy monetary policy. In fact, I think it's probably safe to say that the sort of groundswell of support that populists have seen on both sides is largely a result of significant dissatisfaction with the highest inflation that consumers have faced in 4 decades. And the last time we had a president who tried to influence the Federal Reserve, I suppose all presidents have attempted, but the last one maybe that succeeded, arguably was President Richard Nixon. And I think it's pretty safe to say that Arthur Burns and others at the Fed who may have complied with his will to keep rates low for whatever political motivations he may have had, is fairly clear with the benefit of hindsight that that was a terrible mistake. So my hope is that we do not get that as a potential issue. Okay, so I'm just quickly going to take a look at some of the comments. Finwest says, "Good morning, Mike. Goodbye to a wild Q2." Wasn't it, though? It was a wild Q2. I think we could see a little bit of choppiness coming up. I mean, we are at all-time highs. Valuations are looking a little bit elevated. I think I'm vaguely concerned that we could see some conflagration on the tariff front, although it does seem like we're getting close. Europe, the negotiators appear to be going along with this notion that there's going to be a sort of a 10% across the board tariff. They are looking for exemptions in certain areas, including autos and auto parts. There was a threat made today from the president with respect to tariffs on Japan, which, so all of these things are kind of lingering under the surface, and we hope that they don't get a whole lot worse. But we have seen some concessions. The issue with Japan has to do with rice. According to the president, they have a shortage of rice. They're not willing to import rice from the United States, or at least not on terms that the administration sounds favorable. But at the same time, my former boss, or I should say my former boss's boss, the current Secretary of Commerce, Howard Lutnick, said that essentially a deal has been reached with China. That is clearly a positive. So I think as we get closer to essentially putting this tariff uncertainty behind us, that is going to, potentially help propel the markets, believe it or not, even a little bit further. And of course, if the bill gets passed, I think that also could. But part of the reason that I think that that's true is because if the bill passes, there is some reason to think that you want to own real assets in that case, because again, we're still dealing with the high deficits, growing debt. We don't seem to have any real fiscal discipline getting introduced, at least not in the big, beautiful bill as it currently stands. And that ultimately is somewhat inflationary. So I think that's a bit of an issue that we still have to face. So over the weekend, I happened to download, because I hadn't played with it and I wanted to, the installed version of Tasty Trade. So I created an account. I didn't fund it. Just wanted to use this application just to sort of see how this thing would work. And this is sort of the landing page that you get. And I was just taking a look at the watch lists, which is kind of interesting because you can get things like Tom Sosnoff's watch list and a couple others, that stocks that are at 52-week highs, 52-week lows. And this one is just earnings. And as you can see, we have I don't know what the subset is on this watch list. I think it's just looking at the recent symbols. But Constellation Brands is going to be reporting tomorrow after the close, and this is the name that I wanted to talk a little bit about, in part because this is a stock that really has performed just terribly over the course of many months and actually years. And it's not just Constellation Brands that has. So all of the alcohol companies, the liquor companies. So we can take a look at Brown-Forman, and you're going to see kind of a similar situation. I'm just going to go back. I'll go back 10 years so we can get a good look at this here. There we go. And you can see that Brown-Forman is, it's at the lowest level in 10 years and by a healthy margin. Same thing is true here for Constellation Brands. Also has not been performing well. It's not quite as bad as Brown-Forman, but you can see here, I'm just going to draw a line. This gets us back to levels. Effectively, we're at levels where the stock was back in 2016. And, one of the other reasons that I was taking a look at this thing, not just because of earnings, although, the fact that the stock is close to 52-week lows or at 52-week lows, the fact that it does have upcoming earnings, the fact that it has performed so badly, is that they just completed a corporate action. So earlier this month, we're now at the end of the month, but earlier this month, the company managed to divest several of their wine brands. They sold them to a company called the Wine Group, LLC. And I think I actually brought up, I have it here. Okay, yeah, so I just happened to go through, so if, you may find this interesting, you can go to the Constellation Brands Investor Relations website. They have a number of presentations there. And, I was just scanning through some of them, but I was kind of interested in this divestiture of these wine brands and kind of contemplating what's going on here. So, what has been the knock on the alcohol companies of late? One of the issues is, well, first of all, their sales have not been growing. Their sales have not even been growing with the economy. Certainly not the economy plus inflation, or even at the rate of inflation. There really does seem to have been some significant stagnation in beer, wine, and spirit sales. And part of the reason that people have pointed to, there's a couple reasons. We'll talk about them. One of them is the introduction of some of these obesity drugs, which apparently curbs folks' appetites for certain food and also for alcohol. Second is that some of the more recently released health studies have kind of debunked things like the French paradox. So for those who aren't familiar, the French paradox was, how come they eat high-fat, fatty foods and they drink wine, and yet they seem to be healthier than everybody else? And there was this thinking for a while that maybe the alcohol was actually helping them in some way, and that modest amounts of alcohol could actually make people healthier. So a glass of red wine a day would actually improve people's health, maybe offset some of the health risks associated with fatty foods, for example. So if you have a steak dinner and a glass of red wine, you're better off. Some of the more recent studies are suggesting that that isn't necessarily the case. I would argue that a glass of red wine with your steak dinner probably improves your mental health. That's just me. But in the midst of all of that, we also have seen the cannabis companies come online, and there's big increase in cannabis use. And there is, some concern that whether it is for perceived health reasons or whether it is for economic reasons or just changing consumer habits, that cannabis would potentially be a bit of a threat to the alcohol companies. Now, in the case of Constellation, Constellation does have an investment in that space, although we could argue that that's more of a hedge than it is necessarily the direction that they're taking the business. But, and this you may also find this interesting, I'm just going to use Google because I managed to get some statistics here. So growth rate for alcohol sales globally. And if you do something like this, it's interesting because they have Gemini, and it's going to come up with some statistics, and it's going to link back to some reports. But one of the things you're going to see here is this compound annual growth rate. And the compound annual growth rate for alcohol sales at the lower end actually is in or around the GDP growth rate. And the upper end of this estimate, because what you have is in places like China and elsewhere, the per capita GDPs have been rising, and as people become more affluent, maybe they start, drinking more and things like that for social reasons and so on. And then you combine that with this recent divestiture. So what was going on there? What Constellation decided to do, and I think I like this strategy, was to focus on the upmarket wine business in particular. So they sold Woodbridge. They sold Robert Mondavi, what do they call it? Private selection or something like that. It's actually not Robert Mondavi. So Robert Mondavi Vineyards is a very upmarket brand, and they actually preserved a number of upmarket brands. So Mount Veeder, for example, is one of these. I have had Mount Veeder wines. I like them a lot. The Prisoner is another one that they decided to maintain. And if you go over and you take a look at these things, you're going to quickly realize these are not cheap wines, right? So this is not necessarily representative of what you're going to find at your nearby Safeway, but Mount Veeder's not an inexpensive bottle of wine. This is not a Woodbridge. I don't even know what Woodbridge costs, but let's call it $10 a bottle or something like that. Same thing is true for the Prisoner and some of these other brands. And the reason I bring this up is because I don't believe, my own take is that I don't believe that people who go out to eat and get a nice bottle or enjoy nice wines as a part of their table wines. I had, for example, a friend in Austin, and their default table wine, they would have a bottle of this with dinner, was Stag's Leap, which is another upmarket brand. I don't see those people changing their habits. The people that drink Mount Veeder or Prisoner or Stag's Leap, which is not one of their brands, these people are not going to switch to eating gummies. That's just not real. More than that, the margins on these products are going to tend to be much higher, as you would expect. So it's not to say that there's an insignificant marketing cost, and certainly relative to the unit price that they get for these things. But the fact of the matter is, you probably have not seen a lot of ads for Mount Veeder. You have probably not seen a lot of ads for Prisoner. You can see that these are upmarket items and that people are buying them. So my thinking is that, in fact, I actually wrote an article about this over the weekend. I think that the funeral dirge for the alcohol companies is premature, and in Constellation's case in particular. Now, I want to just make another quick point, because I think this is important as well. I don't want to make it seem like, okay, so these guys are selling $150 bottles of wine and they're totally immune. I think it's important that we take a look at how, where their revenues are coming from. And I just wanted to quickly point out that 80% of the revenue is beer, and that less than 20% is coming from wine and spirits. So they have, in the United States, Modelo. We've talked about this before on this channel. Just as a reminder, for antitrust reasons, Modelo in the United States is separate from Modelo elsewhere. And also, it became the best-selling beer in the United States. When and why did that happen? Because actually the best-selling beer in the United States beforehand was Bud Light. And for those who don't remember, there was some controversy, some political controversy that happened to surround their decision to get as a spokesperson, and it was probably maybe 2 years ago or something like that. It was probably, I think, during Pride Month, but they got a new spokesperson who was going to promote Bud Light as they were trying to broaden the demographic. I think the person who was leading the brand at the time described it as too fratty or something like that, and so they wanted to expand. And then that was not particularly well received, and a boycott resulted, aided in no small part by viral videos from people like Ted Nugent and whatnot. And that boycott ended up leading Modelo to displace Bud Light as the best-selling beer in America. But that brings up another point, which is that on the obesity drug front, of course, there are some people who need them, will use them, and that's almost certainly going to change their behavior. But there are many people who are consuming those obesity drugs on a voluntary basis. They are paying for them. They are quite expensive. And it's not clear to me that the average social beer drinker is going to change their habits materially, or that they're going to move away from beer consumption for economic reasons while they're also paying up to get an obesity drug. So I don't know that the upper end of that CAGR estimate between now and 2030, 2032 of more than 9% annualized is realistic. But I also don't believe that this sales trend, which we're seeing here, is necessarily representative. So you can see that we're down, in the single digits in this year, full year. Now, remember, there's a divestiture in this, right? So this is one of those important things. You can look at statistics, just make sure that you remember what the drivers of those statistics are. You have a business, you sell a portion of that business, you're going to see an impact. In this case, you could see sales falling off, and you say, oh, the sky is falling. Well, if you get rid of brands like Woodbridge and Maomi or whatever, then you're going to see as they divest, it also straightens out their balance sheet a little bit. So I don't exactly know, the terms of this whole deal weren't disclosed, but I do think that the pivot makes a lot of sense. So now I actually want to draw your time and attention then instead to these numbers down here. Let me see if I can blow those up just a little bit. Oh, he already blew it up. Okay, good. So you guys can see these numbers down here. What are the numbers I'm trying to draw your attention to? I'm going to throw my cursor on it. These ones right down here, free cash flow. We love free cash flow. And I'd like you to just take a look at next year's estimated free cash flow versus the current market capitalization and enterprise value. So the street is looking for almost $2.25 billion in free cash flow. So let's just call it that. We'll call it $2.25 billion, and we'll call the market capitalization $29 billion. That's 7.75% free cash flow yield on fiscal year 2027 numbers. And by the way, fiscal year 2027, because their calendar year their fiscal year and calendar year don't line up, that fiscal year is actually for the period ended at the end of February of 2027. So, you're talking about 18 months out, basically. For the current fiscal year, which we're basically, almost halfway through, even that number is not so bad. We'll call it $1.55 billion over 29. That's 5.34% free cash flow yield. And now, clearly, this is a lot better in terms of free cash flow yield than it is for the S&P generally. We kind of expect that because there is some, trouble here that, all of the things that I just outlined. But I would point out that that's about 100, by my work, the free cash flow yield for Constellation is probably 100 to 150 basis points better than others in the industry. Okay. And if you don't want to take my word for it, which is fine, and look, this thing looks terrible technically. It's not as if I'm the only one who seems to think that there might be some value here. It's well known that Berkshire Hathaway has a massive cash hoard. They have not been deploying that by and large, but this actually is a bit of an exception. As you can see here, they're actually one of the largest shareholders. And by the way, Vanguard Group, this is passive, right? So we're talking about index funds and the S&P 500, low-cost funds and things like that. So these are multiple portfolios. This is an active decision that's going on here when you're taking a look at these guys. And this is a relatively recent situation here, right? So if you'll notice, they basically had no position in here, and then as of their most recently reported 13F, which came out in mid-February, all of a sudden we see that they announced this huge acquisition. And their cost basis, this is an estimate, but basically what Bloomberg is doing here is they're saying, okay, they had no position at T1, they had a position at T2, they take a look at the average price over the period, and then they come up with a cost basis estimate. But the simple version is that they're estimating that the average price of the stock was around $204 a share during the quarter when they acquired this huge position, and the stock's 160 now. So basically, what that means is that if you elect to start buying Constellation, which by the way is going to pay something in the neighborhood of a little over $1 a quarter in terms of its current dividend, next one I think comes out. We can double check this. It comes out on I think it goes ex-div on the 13th of August, if I remember correctly. No, okay. So my memory's not completely shot. So it's $1.02 is actually the dividend. Yeah, and it was $1.02, so I wasn't completely right, but the timing is correct. So a very nice dividend yield, and we have earnings upcoming. They're going to report it tomorrow after the close. If you're so inclined to try to get a little bit of juice out of the potential vol crush that could follow it, I was just taking a look at the August 8th 160 puts. The August 8th 160 puts, now they widened out at the close. If you're taking a look at this, probably a little bit hard to see, 440 bid at 760, but the mid-market price was about $6 when I was taking a look at this. Probability of profit was more than 60%. So this is kind of what I like to do on the credit side. And by the way, if you're wondering why am I looking at August 8th, remember that I just pointed out that it goes ex-div on the 13th. So the subsequent expiration, which is regular way August, the 15th, you're going to see that expiration is going to have probably a better mid-market bid. Let's just take a quick peek here. So one of the things is that because that's ex-div, that's going to get priced into it a little bit. So I was just trying to make it clean, if you will. So the reason I was looking at August 8th is because that expires before the ex-dividend date, captures the earnings result. Now, the street, by the way, is looking for a single-digit sales decline. So just so everybody's aware, numbers come out tomorrow. So you can, this is I'm probably going to be selling these. I did not do it yet. Probably going to be selling some of these puts tomorrow ahead of the print. And the idea is that, good cash flow yield, decent dividends. If I'm put the stock, getting more than a 4%, premium collection by selling these puts over the 160 strike, and then maybe sell some upside calls against it. Is this a stock I'm expecting to, take off? Not necessarily. I think the average analyst price targets, just over $200 at this point, which is substantially higher than it is now, but folks have been lowering their price targets. In fact, I think of the 10 price target changes that we've seen in this stock, most recently 9 were downgrades, but it's still pretty well liked. And, sometimes I'm not normally an advocate of trying to catch the falling knife, but I think on a valuation basis, and then let's just talk about it. I was talking about it on a free cash flow basis, but I think it's just worth taking a look at it on a price to earnings multiple basis. So the adjusted EPS estimate for next year, which again, remember that the end of the next fiscal year is about 18 months out, a little bit more. So Street's looking for about 13, round numbers, 1380. We'll call it 163 a share. So that's trading less than 12 times forward earnings. Something to think about, just because there's so much. I'm trying to be a little bit contrarian here. I'm trying to find things that people have just left for dead in a market that people think just can't quit. And Tom Lee was on Squawk. I think it was this morning. I happened to see a highlight, so I don't know if it was this morning or last night, but he was basically saying this is the most hated V-shaped bounce or rally. Yeah, probably true. But anyway, that's the name that I was kind of thinking about. Thought you guys could give it some thought. Okay, so James Foreman, your opinion on Coreweave. Well, let's take a look at Coreweave. I think I struggle a little bit with companies that don't have huge operating histories, where I'm not sure I completely understand how big the market opportunity is. Coreweave obviously trades at a pretty chunky multiple. You can see it right here. We were dealing with round numbers, we'll call it an $80-90 billion business, depends on whether you're looking at the market cap or the enterprise value. So it's trading many, many times revenues. The revenue growth story is pretty spectacular, needless to say. We're looking at something, and I think didn't we talk about this, I think, on one of the recent live streams. Obviously an exceptional growth story. Does it make sense? I wish I had more to tell you, but it's funny. I was thinking, I should probably talk about Nike as well, because I think this is one of those cases where there are certain types of businesses I feel like I have a way to sort of contextualize, even if I don't understand every aspect of what the company is up to, but I can sort of say, okay, well, let's just take some general operating assumptions and use them as a baseline, which is the reason I referenced Nike, which is obviously a completely different business than Coreweave. For those who are not familiar with Coreweave, this is sort of a primer on what they do. It's clearly because it's in the cloud-based software solutions business. This is really critical in the AI build-out. They're right in the crux of it. So are they You know, are they as core to it as, say, NVIDIA is, or are they as core to it, let's say, as more legacy chip companies are, like Micron, that are benefiting from the build out because their technology is also being used, even though they're on the software side? It would certainly seem so, based on their top line growth numbers. But what's a reasonable number to throw on this? I wish I had a better answer for you. I'm going to just blow this out so you can see what the street's expectations are, and you can get a sense for just how ambitious these numbers are. You're looking at a tenfold increase in anticipated revenues for this business over the course of the next 4+ years. That's kind of what the street is looking for. So that's over the next 4.5 years. And, they're looking at adjusted net income. This is the street's estimate of about $2.6 billion. And again, that's 4.5 years hence. So if everything came together, let's just call it, I'm just going to use some midpoint between the market cap and the enterprise value. We'll call it $85 billion. And maybe I'll be a little bit conservative on that assumption and call it 2.5. So how do you feel about paying 34 times 4.5 year hence adjusted earnings per share? I don't know. I mean, that's if they could keep up that growth rate, that would be very reasonable. But take a look at what the growth rate is expected to be at that time. Now you're looking at a 23% annualized growth rate. So you would be paying 34 times 29 numbers on an anticipated 23% growth rate at that time. This is high duration equity stuff, right? So what that means is, if we don't get anticipated rate cuts, if we do see some volatility in the market, very high beta, I'm sure that you could go back 10 years, and if somebody had said, hey, how do you feel NVIDIA? I might have said, wow, it's a little bit expensive, and I don't know that I could have actually forecast just how spectacular their growth would be. But these numbers they're a little bit eye-watering. I'll leave it at that, and leave the rest of to you. Kupang, Josh Brown called it Amazon of South Korea on halftime. August 15th, post-quarterly earnings result, in the money 27 or at the money 30 or out of the money 33 long calls. Shall I just hold my nose and buy it? Well, let's take a look. So, this is, when you say hold your nose, I guess the point I would make is this is a very different situation than, say, a Coreweave situation. Is it a cheap stock? No. Is it, mind-numbingly expensive? Well, no. It's trading less than 2 times full year estimated sales. We're looking at a business that's trading, as you can see, less than 30 times next year's estimated and adjusted net income. So not terrible, but this is the other thing. You could take a look at the upside growth. You're growing the business at a much better rate than the economy overall. It's not unreasonable. I think probably the reason that you're saying hold your nose is because of this. And it's awfully tough to chase it, right? So, but the funny thing is, and I think this is an important point to make, so we are looking at a stock that's up 50% off of the lows, but I wouldn't really focus on this because it was a V-shaped bottom, right? So instead, I would actually say, okay, well, this is where it was, we're looking at something that's 11.5% higher than it was in and around the period of the election. Things will be volatile. So I wouldn't look at this number and say, okay, I don't want to buy it here because it was once there. I would actually probably, say, look, most of us didn't load the boat on equities, unfortunately, in the Liberation Day sell-off as aggressively as we wish we had. So you kind of have to put that out of your mind. That was a little bit of a miss. but it's not terribly valued here. If you were interested, one thing you could do is you could potentially sell some downside puts. They are, I'm going to put this in here so we get a better sense of what that valuation looks like. So put a 30-day implied vol. So the implied vol is a little higher than what the thing has been realizing lately, 36, 37%. Maybe sell some puts to work your way into the stock if you want to. That would be a way you could potentially play it. Don't pay too much attention to the fact that you missed the bottom. We all did, or most of us did. I think that one's all right. Steve Garcia, is EPS alone meaningful in stock evaluation, or only when used with price to earnings growth, etc.? Did I throw this on the board? Yeah, I think so. If a company has earnings per share of 50 cents and company B has earnings per share of 20 cents with the same price to earnings growth debt, would you prefer B for higher EPS? No, it's all relative, right? You're just simply saying how many slices are you dividing the pie into, right? So I will say this, okay? It's not on a per share basis that I really care too much. I do start to care a little bit about laws of large numbers. What do I mean by that? And what I mean is that if you have an extraordinary growth rate for a business, when businesses are small, they can keep those growth rates up for quite a while. But at some point, an extraordinary growth rate has to slow, because what business is going to take over the entire economy, right? So just laws of compounding suggest that at some point, growth for any business on a relative basis is going to have to slow. You can't have a company that's growing at 100% a year every single year forever, because sooner or later, it would be the only economic activity going on the planet, which is clearly not realistic. So in that sense, I do care a little bit about the size of the numbers, but it's the multiple that you care about. And here's the way to think about it. Instead of thinking about it price to earnings, 20 cents a share, 50 cents a share, $100 a share. I mean, look at Berkshire. Are Berkshire A shares more appealing than Berkshire B shares because they have a higher earnings per share? Well, obviously not, right? So earnings per share for the full year for the Class A shares is, 30,000. What are we looking at here? Yeah, so $30,100 a share. But that's not the issue, right? You can buy the B shares, and it's gonna. Oops. This is not adjusting to that, but what it should be is, so it's showing me the financials for the A shares on the B shares. That would be very nice if you could pay $485 for a share and get $30,000 in EPS. That's not how that works. What I'm saying is that the multiple here is going to be the same in both cases. So you're, paying whatever, 24 times or whatever. And by the way, important point, that's partially because Berkshire shares are almost half cash, right? It's like 43, 44% cash for each share. So if you take a look at the earnings over the value of their underlying businesses, the turn is much lower. So essentially, you're paying, that multiple is partially because you're paying a multiple on, the interest that they're earning on their big treasury position, right? But yeah, it's the multiple that matters the most, because if you take the multiple, let's say you have a PE of 20, whatever the price of the stock, 1 over that number is your corporate earnings yield. And if you have a growth rate, let's say, of 8% a year. So if I have a P of 20, that means I have a corporate earnings yield of 5%, and it's growing at 8%. Think about it like that. And you're not going to start caring about whether this is 20 cents and that's 50 cents and that stock's $500. You're really worried about your corporate earnings yield and how fast that earnings grows. Those are the things that matter. And actually, in some places like in the UK, they sometimes divide the stocks up so small, you're paying, £3 for a share, right? And everything's being measured in fractions of a pence. Other than the fact that depending if you pay on a per share basis, that can increase your transaction costs. The truth of the matter is, it's your corporate earnings yield, growth rate, cash flow yield, things like that matter. Think about it as if you were just buying the whole company outright rather than just a share of it. And you would look at those metrics. You wouldn't even be worried about the per share. Whether you divided it into one share or a billion, wouldn't matter. Okay, let's see here. Jasmine Joe says, SPX is strong. Yeah, it sure is. And yeah, I talked about this a week ago when we had Tony Zhang on, and I had mentioned the fact that we expected that the S&P was going to get to the prior highs because the technology sector, which was kind of leading the way, had already broken out to new highs. The XLK was the thing that we were looking at. Like I said, I also think you get tariff deals and you get this bill through Congress, and I think those things are tailwinds. Last week we had the bank stress tests, so they, it's each of these things are little helpful bits along the way. It just frees up more returning cash to shareholders, increasing dividends, share buybacks at the financials. So, all of those things sort of help out. And I saw a piece that was put out by Oppenheimer, I think it was, and their biggest concern was that they were looking at the advance versus declines, and they were just saying that we're reaching new all-time highs with a very low number of stocks hitting fresh all-time highs, and they didn't seem to be too enamored of that concentration. And my expectation, sort of like this whole business with the stress test, is that as long as the news is okay to good, then you will start to see some broadening and the rally can continue. That's kind of how I read that. All right. Can you tell if VRT is near a breakout at 128.5? Thank you. Well, I'm not a technical analyst, but we will take a look at some technical studies together. Wish we had Carter on here. He could probably talk a little bit about that. So let's just take a look at one of his favorite metrics, which is the 150-day moving average. We can throw that in here. So at least on that basis, it looks like, are we near a breakout or did we just have one? And then just taking a look at some other technical studies. And I'm just going to rank these by the best performing ones over the course of the last year. And you can see that by and large, including the two best performing technical studies, they are indeed long Vertiv at the current level. So which are the ones that are not? Stochastics and the Commodity Channel Index, which tend to, and RSI, which all tend to be about overbought or oversold conditions and are kind of a short-term indicator. Again, I'm not a technical analyst, but this is something that Tony Zhang did bring up when he was on, and he was speaking specifically about the CCI, about the Commodity Channel Index, and how he looks at that as a valuable indicator in the context of whether or not the stock is in a larger uptrend. So the question is, do you believe that this thing can actually get back to this prior high? And this is the unfilled gap that it looks to be seeking to fill, and I suspect it looks like it's going to. Hope that helps. You guys can see the same things I can see, right? So if there's anybody who's watching who spends more of their time focusing on the technicals, by all means, feel free to chime in. Oh, by the way, one of the things I'm hoping that some of you viewers will chime in on, we're going to put a link to this. We did a little bit of a pilot on an over-the-weekend look-ahead for economic announcements where I was just sort of talking about the top 5 biggest economic announcements coming out this week, like non-farm payrolls, ADP, stuff like that. We're going to put a link to it. It's an unpublished video, but we're going to put a link in the description. Give me your feedback if you like this kind of thing, don't like this kind of thing, like the format, don't like the format. Let us know. So we're going to put a link to that in the description to this video. Check it out and tell us your thoughts. See if this is something that would be helpful. We are talking about folks that might potentially sponsor that activity. Okay. So Finwest says, I think the earnings watch list on Tasty factors in liquidity, so it's not a complete list of everyone reporting, which indeed I think makes good sense, right? So I also don't happen to look at everything that's reporting. I have, as you guys have probably noticed, and certainly in a public context, I will typically, I mean, I guess the short version is I typically focus on large cap stocks. That's not to say that I don't have an interest in small and mid cap stocks. I do certainly have an interest in them, but I don't publicly discuss small cap stocks so much because there are potentially liquidity problems. The bid-ask spreads can be a lot wider in some of those off-the-run names, and that doesn't mean that they're unattractive to trade if you're being judicious with your limits. But if you have wide bid-ask spreads, I don't want to start talking about, oh, you should sell puts in such and such a stock when they have a $2 wide spread on a $5 option. And I think the fair value to sell that put might be 5.25, and somebody just goes out and hits the bid and sells it at 4 or 3 3/4, and that totally changes the dynamics. So, like I said, I'm just starting to play with Tasty. I have a lot of respect for the people who built the platform, and I know a lot of you are using different platforms, and some people have asked me questions. How do I do this on this platform or that on the other one? And if I don't use them, I have no idea what you guys have access to. So I figured I'd open up a couple accounts and see what's going on. Finwest also says, you're lucky you live near Napa, Sonoma, Mendocino. Go to the source for wine. Yeah, it's interesting. Well, I've never gone to Mendocino for wine. I think Mendocino, being part of the Emerald Triangle, is actually better known for the dope they're growing up there, and not all of it legal, or maybe much of it isn't. I think they actually have a documentary about an area of Mendocino called Murder Mountain. That you might find that on Netflix or something. The only reason I actually went up to Mendocino in recent years was because my kids had a swim meet up there back when they were doing swim instead of football and lacrosse. So we went up there. We also had a lot of fires down here, so we were trying to get away from the smoke. The other thing is we always used to go up to Sonoma and Napa a lot before we had kids. And then when our kids were little, we would go to Sonoma because they had a place called Train Town or something like that, very close to the town square in Sonoma, and we could take the kids up and ride around on these trains and go have lunch. Admittedly, I don't go up there anymore. Maybe when the kids are off to college or something. James Foreman, I'm sure you're talking about Coreweave. Sounds like Cisco in the early to mid 90s. Oh, by the way, Cisco, yeah, that was kind of a remarkable situation. So let me see if I can put the max in here. So this gives you some perspective on Cisco. All right, so there's your all-time high in Cisco. And you can see that the guy who top-ticked that thing, they're still waiting, right? So this is Cisco has made a lot of money since 2000. But that doesn't mean that people who bought it then did very well. In fact, if you bought it then, you did terribly. I remember distinctly because this was early days for my brother and I living in New York and working in the business at the time. And I knew that my father had some Cisco in his retirement accounts. And I remember I drove up and I pounded the kitchen table. And I said, I want you to remember this distinctly. I'm pounding the kitchen table because the valuation on Cisco is untenable. And I told him, I said, if your business was valued the same way Cisco is, you'd already be worth $250 million. So I said, just think about that for a second. Who would buy shares of your business at $250 million valuation? That was a business that had revenues of like $1 million a year or something like that. So it was absolutely insane. And that's the issues. It's one of the reasons I think because my formative years occurred during that time, and because I've seen how long it took for some of those investments to recover and how many of them never did, that I have sort of more of a deep dive fundamental approach. And one of the byproducts of that is that sometimes you miss out on some of the best and most compelling growth stories. But I would actually argue that the valuation for a lot of the modern technology companies is not anywhere near as crazy as it was then. So, Alex V, hello, Mike. What do you think is next for IBIT, IBIT? We're talking about the Bitcoin ETF. Looks like it is currently range bound. Is there reasons for Bitcoin to advance by November maybe? The short version to this is yes. And I will say, actually, I'm a little bit surprised by Bitcoin's performance in the context of how everything else is doing. So, we're trundling along here. It has been underperforming equities most recently. This despite the fact that we've had a lot of very positive news on Bitcoin treasuries, corporate Bitcoin treasuries. We have a much friendlier regulatory framework for it. I will suggest that if anything makes me positive about the fact that Bitcoin has sort of been just going sideways, it's that there appears to be some perception that everything else is okay. So in its own way, that's good. The flip side of that, though, is that I don't see Washington fixing their problems. And if they don't fix their problems, then one of the principal reasons for being interested in, hard money, or hard currency, I should say, real money. So whether it's precious metals or Bitcoin or things like this, is that I haven't really seen any fiscal discipline. Now, if we manage to keep a lid on inflation, if that comes in and we don't influence the Fed too much and rates come down, that does reduce interest expense. So that actually could help fix a portion of the fiscal problem, just a small portion. But ultimately, I have a feeling that this is a pause. I see Bitcoin higher before the end of the year, perhaps substantially higher. Actually, I don't know who it was. It may have been Tom Lee. Somebody was talking about Bitcoin 150,000 by year end. Yeah, I think that's entirely possible. But folks who follow me will know that I'm always looking for alternative to fiat currency. So that would make me a Bitcoin bull, a silver bull. Gold obviously had a big tear. I thought the silver gold ratio was such that silver was due for a catch up. It did start to do some of that catch up. I mentioned the same thing on the platinum side. Yeah. So hope that that helps. Monday Morning Quarterback says Mendocino County is up and coming for wine. That could very well be. It's very easy to get up to Sonoma and Napa from here because they have a train actually that leaves right from Larkspur Landing. So anybody's coming up visiting, you're in San Francisco, you can take a ferry to the Larkspur Ferry, and then there's a train right over there. Go up and do your tastings and don't have to worry about driving. It's all good. Alex V says, my insurance agent tells me that house insurance skyrocketed in the Napa area after those fires. He is selling his place there. It's not just Napa. It's here too. It's actually completely out of hand. Now, it matters whereabouts you are in this area, whether it's considered higher risk for fires or less. Where we are is quite close to the bay. But I will tell you that the insurance situation is just ridiculous. And part of the reason is, number one, the insurance commission, the way they're regulating the industry is problematic. We've got insurers pulling out, so there's less competition. That is problematic. You have policies that have, in some instances, discouraged activities that would have reduced fire risk, like controlled burns, clearing underbrush, cutting fire roads, All of these, there's a lot of things that could have been. We haven't been building new reservoirs, certainly not to keep pace with the pace of population growth. There has been this whole narrative that, you know, part of this is due to things like climate change and less precipitation, but that's not entirely true. Our reservoirs have been completely full, but we don't have new reservoirs. And then people who followed the Eaton fire and the ones down in the LA area know that one of the largest one of the largest reservoirs that was closest to where the fires were, particularly in the Palisades, was actually empty and had been for about a year, supposedly due to maintenance. You know, a lot of these problems are man-made, and if you discourage people from competing to provide insurance to the region, and you discourage activities that reduce fire risk, inevitably the cost of insurance is going to rise. I mean, not too hard to figure this out. It's disgraceful. It's really a mess. So anyway, now supposedly I skipped one in here somewhere. I'm going to get back to it because I'm just going to sort of continue on and then we'll go back. Eileen, this V-shaped move in the market is so surprising. If there's another quarter of GDP contraction, that's technically a recession. Right. Yeah, so you need to have a few consecutive periods of contraction to formally get into a recession. That is true. I'm not sure that that's quite where we're at. I will say that, you know, something that does concern me is this, and this is also inflation driven, is this bifurcation where we see increased savings at the upper end and significantly decreased savings and available cash in, you know, the median household. And that does create some problems. And I'm a little bit concerned about the consumer. I mentioned that more than once. I still remain a bit concerned about it. But, yeah, that's true. If we get more GDP contraction, I'm not actually expecting that, though, admittedly. Joseph Kamen says, check out Dow Cabernet Pasterolis. Yeah, I've had that one. Social questions, I'm being told by the producers. These are not the things to... But I do think it's kind of interesting. I have had Dow. Pasto's a different area south of here for those who are interested. Reasonably priced, that one, I would say. Was 2001 when Larry bought his island, Harley Bob says. Larry Ellison. I don't remember what year he bought... he bought Lanai, right? So he owns more than 90% of it. I don't remember exactly when that was. I do have a friend who's I don't actually want to mention which one of his parents is on the board, because then you'd probably be able to figure out who he is and who that person is. So, but yeah, a lot of the board members actually have properties out there, and he's been investing a lot in Lanai. In Orinda, California, more than 50% of the home insurance policies were canceled. That's true. So a lot of insurance policies are being canceled, which is problematic. There is a state-offered program, but it's not that great, and there is a cap. And by the way, I will say that my hope is that the pendulum is swinging back to a more sensible approach on the political front out here. And if it does, then that could, it could be good for the insurance industry, could be good for California real estate. But to put things in perspective, I don't know if this is true, but I was talking to a homeowner who has a house about a mile in this direction from me right now. I estimate that property, because I've been there, I don't know, 5, maybe 6 million. They told me that their insurance bill is $100,000 a year. And that's not in the highest risk fire area. I don't know if that's true, but if it is, I mean, that's just crazy. And, and then you've got your taxes and everything else. It's not sustainable. So my suspicion is that there's going to be some changes. And the changes don't have to come in the form of a party change. We had 9 Democrats running for the mayor of San Francisco, but they certainly all didn't have the same platform. Dan Lurie heir to the Levi Strauss fortune, who was a nonprofit guy. He ended up winning. And, a lot of the things that he talks about make a lot more sense than what some of the other candidates talked about. And I think that's one of the reasons why he won. So I think, all right, so what do I need to do to get this get to the top of the queue? View queue. Oh, there we are. Aha! There we are. Oh, here's the question I missed. PepCap Stick, love your videos and live streams. Thoughts on Apple and Eli Lilly long term? Okay, so first of all, Lilly, 100% best of breed in the obesity drug space, but not particularly cheap. But, I kind of feel like this is one of those situations where you sort of need to buy the best of breed, and it's not as expensive as it was, as we can see. Let's see how much off of its top it was. $30 in adjusted EPS, I think, is what the street's looking for, like a year out or so. 20% off of that. So that's 26 times. 26 times forward earnings. Not terrible. And again, best of breed. So look into this. There were studies that were talking about the efficacy of the Lilly solution and the Novo solution. Novo, by the way, I say go best of breed, but Novo actually is looking pretty cheap to me. But I noticed that the studies were showing that the efficacy of Lilly's obesity drugs was much better than Novo. It was something like a 40% weight loss 12 to 18 months out versus about half that number on the Novo side. Nevertheless, Novo was trading at quite a cheap multiple, I thought, given the fact that they're kind of in this core area, right? So now we're looking at a similar, let's see what we got here. So that can't be right. And that's because it's in the wrong currency. Let's get this into dollars. So $69 a share and 480. Yeah, 14 times forward. Never really traded at a super rich multiple. Does seem to be in the right spot. Got decent top line growth. So I kind of like Novo also, I guess. Now let's move on to Apple. What is my issue with Apple? Two things. So one of them is a news thing that just came out today. You can see the stock's up a lot. One of the things that they talked about with respect to Apple, which I think is kind of interesting, is they are talking about using third-party AI. So apparently they are in talks with Chat, and so the OpenAI folks, and they are also in talks with, let me see here, what was the other one? Anthropic, that's right. So this is kind of interesting because they have touted AI repeatedly as such a big deal, and that was a big part of the reason for the most recent updates and upgrades. And I think people have been kind of disappointed, and they haven't released things. So it's not, their own investments haven't really been working out. The other thing I would say is that, they're relying increasingly on other services for their revenues, and I think we may have talked about that on this live stream. I'm not sure whether it was on this or on Fast Money where it got discussed. But you don't want to see the company making all of its money because everyone who's in the ecosphere is now buying the latest AirPods to supplement or something like that. They're not really gaining on the market share side on the iPhone portion of the business. Although I did happen to notice that the growth in their computer business was pretty good. I don't see anything wrong with continuing to own it. It's not like it's massively expensive, but I don't own it. I guess that's the best way to put it. I don't own Apple, right? I think there are better places as far as I'm concerned. But it's a major market. The other reason is that, of course, if I have SPY, which SPY is what I usually use for my delta exposure, right? So if I've got SPX, I'm trading SPY around it. What's SPY? SPY is largely these large mega cap companies. So I already have exposure to it on that side. My individual single stock selection, I think you guys have kind of picked up on this, is more typically going to be, looking for what seem to be more compelling off-the-run valuation stories, like Constellation. And that's kind of a contrarian bet, right? So the market's all-time highs and the alcohol stocks are sucking wind. I should also point out, they don't necessarily have, it's not like there's a whole lineup of technical indicators that are suggesting that they're going to be taking off at this point. It's obviously a very mixed bag on the technical front. But I'm looking at this because, they're going to be reporting earnings after the close tomorrow. And it's just getting cheap. And my attitude about it is, is this thing going to trade down to 150, 140? Could. Maybe it will. But the valuation is reasonable. Seems like a long-term hold. I think some of the concerns about alcohol sales are probably a little bit overdone. And with that, I have chewed up, it looks like, more than the allotted time of an hour. Please, the unlisted video that's going to be in the description. So you're not going to find it on the channel, but you're going to have to go into the description, click on it, give us some feedback on that if you like what you see. Have some suggestions, let me know. The whole idea is, what are the biggest upcoming economic events for the coming week, and what is the likely outcome? So, for example, if the non-farm payroll numbers comes out higher than expected, what happens to equities, rates, and the dollar? If it comes out lower than expected, what happens to equities, rates, and the dollar? Like that. Because I think a lot of times people are looking at these numbers, but it's kind of abstract, or they don't know what the survey is, or the high end or the low end of the survey. So they're not really sure what the natural knee-jerk reaction of the market will be. Is it going to be helpful for cyclicals or financials, harmful, that kind of thing. So click on that and let us know your thoughts. That would be really helpful. Oh, yeah. So the channel, we just, right here. Yeah, you can just put that up there. So that's, oops. I've just been advised by our crack production staff that that's actually the wrong link, so ignore that one. We're going to get the correct one up there in a second. Okay. How would you value the embedded call in Strike? Let's get back to Strike, Misty, and all that other kind of stuff on Wednesday. So I'll get back to that because that's a little bit more involved conversation. So here, this is the link. That one that just popped up in the lower third, that will be in the description. That's the one I would like you guys to take a look at and let me know what you think. Drink Mount Veeder wine. You're going to like it. All that kind of good stuff. Thanks for watching. I'll see you Wednesday.